Good morning, my dear students. How are you all? Okay. Yesterday holiday, which class? Illa, morning. Morning no session. Actually, yesterday it was my session, but I was having severe cold. So adnala I cancelled in the last minute. Even today I am having little bit cold, so my voice will not be voice audible. Okay. See, today also I'm having little bit of cold, so your voice avlo varadu. So I want you all to be responsive so that the class should go in the proper flow. So little bit problem in the voice because of cold. Maybe in couple of days it will become okay. Any problem at all? Kekudha? Clear irukka voice? Okay. So first question, how are you? Fine or very fine? See, how was your SAP test நீங்க எழுதுனீங்களா? புரியல. FMல 3 क्वेश्चन கேட்டாங்களா? எந்த சாப்டர்ல? which chapter? Leverages. All the 3 questions from leverages? Okay, was that easy? Were you able to handle all the questions? Is that what we discussed in the classroom? Very good, pa. Very good. Okay. So, இந்த ஏசி கொஞ்சம் கம்மி பண்ணிடலாமா? Okay. Okay, okay. Okay. So which chapter we are in? Cost of capital. முடிஞ்சிச்சா இல்ல இன்னும் இருக்கா? கான்செப்ட் ஃபுல்லா முடிஞ்சிச்சு, நான் ப்ராப்ளம் போடுறது. Okay. So before starting, today it feels like a good day, right? ஆமா இல்லையா? இல்ல சார், it is like a normal day, அப்படிதானா? Huh? Okay. So we'll start. Okay, we'll start the class. Cost of capital is one chapter that conceptually we completed. Problems are pending, correct? And capital structure is the next chapter that we are going to start. Capital structure and cost of capital. Now when we see about cost of capital, what you guys will think? Cost of capital na ennadu? The cost incurred to float the capital into the business is the cost of capital. Okay. So in the last class, we understood how to find out all the specific costs of capital. So cost of capital, now we have different sources of capital. It can be through equity shares, it can be through preference shares, it can be through debentures, or it can be through retained earnings. So in the last class, what we understood is how to calculate the specific costs of all these sources of capital, correct? Okay. Now once we understood how to calculate all the specific sources of capital, the next thing is how to allocate. I mean, if I am telling that my equity cost is 20% and my debenture cost is 15%, so what is my cost? Is it 15% or is it 20%? 15 or 20? What is my cost? See, my capital structure is combined with 100 crores of equity and 100 crores of debenture holders. The cost of equity is 20%. The cost of debenture holders is 15%. So what is my cost of capital? Okay, what is weighted average cost of capital? So what is weighted average cost of capital? 17.5. எப்படி பண்ணீங்க? 0.5 weight given to debentures, 0.5 weight given to equity shareholders. So 0.5 into 20%, 10%, that is the weighted cost of equity, and 0.5 into 15%, 7.5%, that is the weighted cost of debentures. So 10% plus 17.5% becomes 17.5%, that is called as weighted average capital. Clear? So weighted average cost of capital. Okay. Next, in the weighted average cost of capital, we weight allocate pannuvom. You all know how to allocate weights, right? It is nothing but simple ratios and proportions. Illa na solli kudukku thevilla, correct? Yes? Okay. So in the weighted average cost of capital, we have two types of weights. One is called as book value weights. The next one is called as market value weights. Book value weight now, whenever we are issuing the debentures or retained earnings, நம்ம ஒரு வேல்யூ புக்ல போட்டிருக்கோம், because afterwards the book value don't change. நம்ம அக்கவுண்ட்ஸ்ல படிச்சிருக்கோம், in the debenture holders or equity shareholders are always recorded at book value. Even though the market price falls or rises, that adjustment is not given in the text accounts. So that is the reason, to find out the correct cost of capital, it is always better to calculate on market value. If the market value, usually whatever we are studying is for listed companies, is not for private limited companies, or is not for privately held companies, or a proprietorship concern or a partnership concern. The financial management, whatever we are studying, is about listed company. So listed company la usually the debentures, the shares, all are traded into the market. Are you guys are listening? Okay. If whenever it is listed into the market, which means their prices changes daily. If the market price of the share changes daily, the market price of the debenture changes daily. So now the question arising is, so which market price I should take, sir? Should I take today's market price, or should I take next year's market price, or previous year market price, or yesterday's market price? Which market price I should take? Because daily the market price keeps on changing. So what is the answer, pa? See, I'll tell you, whenever we are planning to raise the capital, okay, if for example I am getting a project, okay, one person is asking and coming to me, hey Thofik, you have a project for 100 crore rupees. Now what I will do as a finance manager or as a CFO, I will go and first thing is I will plan for this 100 crores, from where I will get the 100 crores, because definitely 100 crores will not be there in my bank account. Some amount I have to issue equity shares, some amount I may issue debenture holders or debentures, some amount I may go for a bank to take a loan, some amount I may be having, okay, in my FD or as marketable securities, that I will put, that is called as retained earnings. If I have planned, okay, 100 crores, right? 50 crores I will take debentures, 50 crores I will use my own money. This is the planning that I did. If the debenture holders I have to issue, correct? What I will see is that we have two methods. One is book value method. Book value method is actually, it is just a value. So book value weight is not having any relevance. Suppose I have issued debenture 10 years ago. So what is the value in the books 10 years ago debentures? அதுக்கு நம்ம இப்போ வெயிட் போடுறோம், and then we are calculating the cost. Okay, practically that is not there, but in textbook we have a concept, book value weights. Clear? Because it is easy to calculate. Second one is market value weight. Market value weight na, if today I were to issue the debentures, at what price I can issue? Maybe 100 rupees face value, my company is very reputed, I may issue that 100 rupee debentures at 150 rupees, which means at 50 rupees premium. So issue price 150 rupees and redemption price 100 rupees. Purida. So what is happening? Because of this, my cost is getting reduced because my issue price is high. But maybe 10 years ago, I would have issued at 100 rupees. அப்போ book value weight na நீங்க 100 rupees weight எடுப்பீங்க. Market value weight na நீங்க 150 rupees weight எடுப்பீங்க. Now the next question, sir, which market value I should choose? Should I choose today's market price? So the answer to this question is, you have to choose the market price of the debentures when you are planning to raise your funds. If suppose I am planning to raise my funds after 6 months, so what I have to do? First I have to expect, okay, wow, what will be my debenture price after 6 months? Okay, wow, and after 6 months, what will be my debenture holders? And then there I have to okay, so after 6 months, what will be my market price? And that market price I have to take, and then I have to calculate the cost of capital, because only that cost of capital, is to be considered to discount, and then we have to take a decision whether I have to accept the project or reject the project. Okay, so specific cost of capital, now you all know. Weighted average cost of capital, now you all know. Now the next thing is, how much debt I should have in my company, how much debt I should have, how much equity I should have, how much loan I should have in my company. Basically, what should be my capital structure of the company is the next question, pa. Purida. So, what is the answer, pa? What should be my capital structure of the company? 100% equity vekkradhu nallada, or 100% debenture is good, or 100% preference share is good? Illa sir, everything equally, you give everything equally, 50-50-50. Or sir, loan vena sir, everything equity, what I should keep? What should be my ideal capital structure is the next question. Purila. 2:1. 2:1 na ஒரு 200 crores loan, 100 crores equity, அப்படி சொல்றீங்களா? Debt equity ratio 2:1, right? So debt 2, equity 1. அப்பனா 200 crores debt வாங்குங்க, 100 crores equity. Is that what you are telling? இல்ல சார், 2 ரூபாய் equity, 1 rupee debt, அந்த மாதிரி ஏதோ கம்பெனியை பொறுத்து. ஓகே, இல்ல, what should be your answer? இப்போ you are the CFO of the company, one person is asking and telling you, sir, this is my capital structure, is it ideal or not? What should be my ideal capital structure is the question, pa. Weighted average cost of capital. What should be the minimum weighted average capital? Adu eppadi minimum? See, today, okay va, weighted average cost of capital is based on how much equity I am having, how much debt I am having. The question is how much equity I should have and how much debt I should have. That is the question. So, if you are increasing equity, your weighted average cost of capital will increase. If you are decreasing equity, your weighted average cost of capital will decrease, because equity is costly. Same way, and the weight மட்டும் நீங்க சேஞ்ச் பண்ணா உங்க காஸ்ட் சேஞ்ச் ஆயிடும். My question is 100 crore rupees, ஓகேவா? இப்போ நீங்க 50 crore டெட்டா வச்சிருக்கீங்க, 50 crore ஈக்விட்டியா வச்சிருக்கீங்க, ஓகேவா? இப்போ நான் என்ன சொல்றேன்னா, your equity is 20%, debt is 10%. இப்போ நான் என்ன சொல்றேன்னா, நீ 100% டெட்டா வச்சுக்கோப்பா. Now what is your weighted average cost of capital? 15% as compared to 17.5%. அப்போ 15% தானே lower. அப்போ 15% best is my question. Again, a minimum weighted average cost of capital based upon your answer. Then is 15% weighted average cost of capital, which means 100% debenture holders, is it the ideal capital structure for the company is the question. When you use it, you just answer. தலை சுத்துதா? No discussions, pa. Talk to me. I'm feeling alone. இல்ல தெரியாதுன்னா tell don't know sir. Okay, what is the answer? எப்படி? What is my capital structure? What should be my ideal capital structure? 100% debt is always cheaper pa. Okay, I am telling you 100% debt is always cheaper. Appo their weighted average cost of capital is also minimum. Then if the answer is minimum weighted average cost of capital is better, then 100% debt is better. Purida. So is 100% debt is the ideal capital structure is the question. No. Reason why it is no? No answer தெரியும், பட் அதுக்கு பின்னாடி இருக்க ரீசனிங் why it is no. Financial? Very good pa, very good. Praveen, right? So அவன் என்ன சொல்றான்னா நம்ம 100% லோன் வாங்கினா my financial leverage will be high. Is that what you are trying to tell? Correct? இல்ல சார், அதை நான் யோசிக்கவே இல்லை. அப்படியா? Financial leverage will be very high. See, if financial fixed cost is high, it means your financial leverage is very high. So financial leverage is high, na it is good or bad? Both. Very good. See, this is matured answer. இதுதான் ஒரு CA level answer. Correct? இதே நீங்க 12th standard BCom அந்த பக்கம் சார் bad sir or good sir நீங்க one line answer கொடுப்பீங்க. But leverage, as I already discussed, leverage is like a double-edged sword. If the company is growing, you are taking advantage of leverage. If the company is declining, the same leverage will hit you back. So leverage is also advantageous and leverage is also disadvantageous. Seri, slow ninga concept kita varinga. So now, as you said, minimum weighted average cost of capital, that is not the ideal capital structure. 100% debt is not the ideal capital structure because there you will have a high financial leverage which is not recommended. Appo sir, what should be my ideal capital structure? Where cost of cap, see, if I take the minimum cost of capital, definitely it will be less than IRR. Purida? Yes or no? See, my IRR is say 25%. Okay, va? My IRR is 25%. Now, my cost of capital, if it is 100% equity, it is 20%. If it is 50 equity, 50 debt, it is 17.5%. If it is 100% debt, it is 15%. Okay, va? Mono case, mono options. 100% equity, my cost of capital is 20%. 50% equity, 50% debt, my cost of capital is 17.5%. And 100% debt, my cost of capital is 15%. And my IRR is 25%. In all the three cases, my IRR is more. Whatever is the cost of capital, I may choose. Now the question is, which capital structure I should choose? Use cheated. Just you are very close. It's just that you have to tell the answer. Based on EPS. Why? Very good, pa. Very good. Can we have a round of applause? கொஞ்சம் எனர்ஜெட்டிக்கா pa. Now, see, one line answer. If I were to give you one line answer, it is the ideal capital structure is the capital structure where the wealth of the shareholders is maximum. That is the one line answer. So what is the ideal capital structure where the wealth of my shareholders is maximum? Now what is the wealth of the shareholder is the next question. Purida. Now the company's EPS, okay, what the company's EPS ipo kaiyila irukku. So earnings per share is the earnings that is available to equity shareholders. Correct? Yes. Now if that is the earnings which is available to equity shareholders, which means I can consider that as wealth. I can consider that as wealth of the shareholder. Can I? Yes. So first, okay, so the first working how I can do is that wherever the EPS is maximum, That is the ideal capital structure. Clear? Point number 1 noted. Second, sir, whatever may be the EPS, the wealth of the shareholder is always the market price of the share. நீங்க எப்படி சார் EPS சொல்ல? That is the second argument. What is the second argument is, sir, EPS is something which I am calling it as book value. EPS is something which is there in the book. Profit is a book number divided by number of shares, that is my earnings per share. But sir, today if I were to sell my shares, what I am going to get is the market price per share. I am not concerned about the EPS. That is the second argument. Okay va? So second argument enna solranga, the wealth of the shareholder is not EPS, the wealth of the shareholder is market price per share. Clear? So the next way to have an ideal capital structure is that the ideal capital structure is a capital structure where my market price per share is maximum. Correct? So two arguments. Okay, first thing, ideal capital structure is a capital structure where my EPS is maximum. Okay, or okay, and the market price information illana nee EPS use pannu. Market price information irunda you have to use the market price per share. Clear? Inga irukka everyone is clear? See, slow நம்ம concept by concept போயிட்டு we are going to complete. Then in the next class I will do problems for both the chapters, cost of capital and capital structure. ஏன்னா once you know all the concepts, problems will be a cakewalk for you. Okay, so இப்போ நம்ம என்ன டிஸ்கஸ் பண்ணோம்? capital structure. So one way to tell what is my ideal capital structure, the first one is where my EPS is maximum, the second one is where my MPS is maximum, which is called as market price per share. So I can write, okay, ideal capital structure. இங்க நம்ம என்னென்ன படிக்க போறோம்னா, first thing is EBIT, EPS and MPS analysis. This is the first thing that we are going to study in capital structure. Second one, what we are going to study is indifference point and financial break-even point. Third, we are going to study net income approach. Then net operating income approach. Then traditional approach. And then approach. Okay, is Modigliani Miller, approach. This is the learning objectives of this chapter, which is capital structure. So I completed introduction of EBIT, EPS and MPS analysis. இது கொஞ்சம் கம்மி பண்ணலாமா? ரொம்ப அதிகமா இருக்கு. புரியல. ஆஃப் பண்ணிடுங்க, பரவாயில்ல. புரியல. மெயின் ஆஃப் பண்ணுமா? Because today I am having cold, right? So that is the reason. Otherwise AC doesn't bother me. அதனால தான் இந்த ஜாக்கெட்லாம் போட்டு வந்திருக்கேன். Not that I am having that good fashion sense and all. புரியல. See, this is the jacket that I received on Valentine's Day. So, but today I wore it because I was feeling cold. அதனால தான். I purchased myself pa. Okay. 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 So நம்ம கம்ப்ளீட்டா எக்ஸாம் அப்ரோச் தான் பார்க்க போறோம். ஓகேவா? ஆக்சுவலி இந்த நெட் இன்கம் அப்ரோச், நெட் ஆப்ரேட்டிங் இன்கம் அப்ரோச், MM approach, adula lot of discussions we have to make you understand what is net income approach, to make you understand what is net operating income approach. So actually ஒரு ரெகுலர் கிளாஸ்ல இந்த நெட் இன்கம், நெட் ஆப்ரேட்டிங் இன்கம் மட்டுமே it will take one full class, but that one full class we cannot afford in revision. So adanalu what I am going to tell you is that I am just going to give you a small introduction. Okay, what is net income, what is net operating income approach, and how to solve problems. Actually introduction kudukame na ungalku just if I tell you the formula you will be able to handle, because net income approach and net operating income approach is one of the easiest, okay, one of the easiest in capital structure. But the only thing is adukku understanding requires a lot of maturity to understand what is net income approach, to understand what is net operating income approach, because these two are the approaches which are given, approach to find the value of the firm. In the rendu approach, so these two approaches have been okay. So these two are the approaches which are given by one person who is named as Durand. So he has given those approaches to find out the value of the firm. Adhe mari we have one more person called as Modigliani Miller. He is also giving one approach to find out the value of the firm. He received Nobel Prize for that. Avlo arguments kudutete he gave this MM approach. So to understand all this, it requires a little bit of discussion, okay, but like sorry, not little bit, more discussion and little bit of maturity. So adanala what I am planning is, in the net income approach, net operating income approach, I will just give a small introduction, and then exam oriented mattum eppadi question solve pannu adu mattum na solliren. Okay va? Yes. Okay. In this, okay va, in this chapter capital structure, mostly questions are asked in net income, net operating income approach. 50% chance questions are asked directly from net income, net operating income approach, or another 50% chances this EBIT, EPS, MPS analysis, indifference point, financial break even point. In the rendathila kepanga, okay va? Those are the two. In the MM approach, traditional approach are very rare, okay va? Very rare those are asked in the examination, but still I am going to tell you how to do. And the MM approach la arbitrage no one irukudhu, okay va? That is again very rare. So adnala what I am telling is that in the MM approach, arbitrage na classroom la edukka matta, you just see in the textbook, because it is very rare, not there to discuss much. What I am going to discuss is net income, net operating income approach, EBIT, EPS, MPS analysis, and this indifference point, financial break even point. That will be the scope of our discussion in this chapter. Clear? Yes? Are you all clear? Okay. So we'll start with EBIT, EPS, MPS analysis. It is actually very simple. I already told you, if you know how to prepare an income statement, it will be helpful in many chapters. So one such chapter is here. So EBIT, EPS, MPS analysis is nothing but the income statement which is starting from EBIT and which is ending from MPS. Ana ungalku EPS varaikkum mattum da theriyum. EBIT to EPS you know how to do it. So EBIT minus interest, what it will be? EBT minus taxes, okay va, then it will be profit after taxes. Suppose preference dividend irunda, that is also getting reduced, okay va, minus preference dividend, what you are going to get is earnings available to equity shareholders. That if you divide with number of equity shares, you are going to get something called as EPS. இப்போ நீங்க என்ன பண்ணுனா, wherever you are having this capital structure, you will be having some options. So option 1, what is the capital structure, okay va, option 2, suppose if 2 options are given, then 2 options, if 3 options are given, then 3 options. Option 3, if debt is more na interest will be more, debt is less na interest will be less, preference dividend is there na preference dividend will come, otherwise it will not come. Like that, you just have to create option 1, option 2, option 3. You have to find out the EPS. Wherever the EPS is maximum, that is the ideal capital structure. Clear? Is this simple? Simple, huh? Okay. See, today alone, I may not be able to shout, okay va? Yena usually classes edukumbodhu this that I have to shout and all. So today I don't have to shout. I will just talk very slowly, very peacefully, very, you know, in a very calm manner. You may be treating this as a lullaby and maybe you guys will be sleeping. So adnala, please concentrate. Don't, I know my voice is very good. You all will be, you know, having the peace. Pa, romba tooka varudhu pa. Are you guys feeling like that? Yaar ni yes nu keta pa. Are you guys feeling like that? No, right? Apna my voice is not good, huh? See, if you concentrate on the content, you will not be, okay, you will not be feeling sleepy. But if you are concentrating on my voice, then you guys will be feeling sleepy. So you have to concentrate on the content pa, okay? So gavanipa, so EBIT, EPS, MPS analysis la, start with EBIT, end with EPS. That is one approach, okay va. Second is, sir, adu okay sir, how will I find out the market price of the share? That is the next question. Purida, yes or no? So market price of the share, I already said you, market price of the share, you have to find out the value of the share. And I already tell you to find out the value of the equity. To find out the value of the equity is like finding the, you know, is like finding God. I already told you. And it is very difficult task. Appa na sir, how will I get to know? How will I get to know what will be my market price in option 1, what will be my market price in option 2, and what will be my market price in option 3 is the next question. Okay, va? So for that, first thing you have to understand is how to find out the value of the share. That is the first thing. Even practically, okay, va? And we have an important ratio. We have an important ratio that is called as P ratio. Now I am going to explain you this P ratio. Okay, va? It is a very important ratio that is used to value equity shares. Okay, that is this P ratio, even practically it is used to value equity shares. Today, if at all you want to find out what is the value of the equity share, the next question is, sir, why should I find out the value of my equity share is the next question. If today in the market, the price is trading at 100 rupees, but the value of the share is only 50 rupees, now is it underpriced or overpriced? It is overpriced. So overpriced, now you will purchase or sell? You will sell, correct? Now, if the value of the share is 100 rupees, but in the market that share is trading at 80 rupees, is it underpriced or overpriced? It is underpriced. If it is underpriced, what you will do? You will purchase or sold? You will purchase the share. Okay, va? So one is called as the value of the share. Second is called as the price at which it is trading. Okay, va? Usually it will not be same. The value may be different. The value is nothing but how much the share is worth. And second one is how much the share I can purchase, how much the share I can get. Now, what is the value? If, for example, there is a possibility that the value of the marker is 5,000 rupees, but it is selling in the market at 50 rupees. Now, why the value of the marker is 5,000 rupees? Because I am using it. So, value of the marker is 5,000 rupees. Purida, are you guys understanding? So, naliki, if I were to auction it to you, நீங்களா இந்த 5000 rupeesல வாங்குங்க சார். தோஃபிக் யூஸ் பண்ணிருக்காங்கன்னா 5000 rupeesல ஐ வில் பர்ச்சேஸ் திஸ் மார்க்கர். ஆனா மார்க்கெட் குள்ள போயிட்டு இஃப் யூ வாண்ட் டு பர்ச்சேஸ் தி மார்க்கர் யூ வில் பர்ச்சேஸ் தி சேம் மார்க்கர் இன் 50 rupees பா. புரியுதா? ஸோ தட் இஸ் கால்ட் அஸ் வாட் இஸ் தி வேல்யூ. சி நாளைக்கு ஏதோ ஒரு ஸ்டோன் இருக்கும், ஓகேவா? The next question is how the value is derived pa. What is the next question? How the value is derived? How you are telling that it is 5000 rupees? What is the calculation behind that 5000 rupees? That is the next question. இப்போ நீங்க போய் டைமண்ட் வாங்குறீங்க, ஓகேவா? If you are purchasing diamond, actually how they are extracting diamond, you know? They will mine diamonds, தெரியும்ல? So diamond mines irko, they will go and then they will mine, lot of feet under they will mine, and then adula edho or stone irko. In that stone those diamonds will be embedded. So diamond is nothing, it is one of the stone pa, okay va? Nothing, it is just one stone. Ninga road la poringa edho or stone paapinga, okay va? So diamond is one such stone that is found there. Actually pathina the stone thana pa. I don't know why lot of girls when I need diamond adala enna pa irukku. It is just a small stone. The only thing is that stone is shining. Avladha pa vyadhyasam. So if someone else is asking you diamond na, you just take a stone and you just give it. But that is also one stone. This is also one stone. You just assume it's a diamond. Idhula neenga earring pottu you just go. So my question, why I'm asking you this question is how the value of that stone is different and the value of the stone that you find in the road is different. That is the next question pa. The ultimate question is how the value is derived. See, nama slow ulla poro how the value is derived. There is a saying. In that saying they say that one person is beautiful or not, it is not dependent on that person. It is dependent on the person who sees. Avanga solluvaanga beauty lies in the eyes of the beholder appadinu or saying. It means if I am telling that you are beautiful, appadina you are not beautiful. Actually my eyes are beautiful that I am seeing you. Purida what I am trying to tell? Idhe mari the value of something is derived by the person who is valuing it. Purida, the value is not there in that share, the value is not there in that product, the value is not there in the diamond. The value is there on the person who is valuing it. Ippo for example, what is your name? Tough name. What is your name? Mohan. Okay va? So Mohan, inge what is your name? Vijay Lakshmi. Okay. So எனக்கு tough name na எனக்கு வராதுப்பா, ஓகேவா? ஸோ அதனால தான். So Thofik is a very easy name, உங்களுக்கு தெரியுமா? Actually it is not Thofik, it is Thofik, but it is a very easy name pa. Actually no one pronounces my name properly. நிறைய பேர் Thofik, சில பேர் Thufik அந்த மாதிரி. Actually I'm telling you the real pronunciation of my name is two syllables. Thofik. Okay va? Thofik is my name. It is just a toffee without K. Sorry, toffee with K pa, sorry. So my name is Thofik. But okay va? Actually if you call my name, if you call me Thofik, it doesn't, okay va? The value of myself is actually not dependent on what you call. It is actually in me only, not on you. So next one, where was I pa? Unga per Mohan and Vijay Lakshmi, okay va? Now see what is happening. Na enna pandrena, I am having a stone, okay va? I am having a stone. What I did, I gave that stone to Mohan, okay va? I gave that stone to Mohan, and actually appadi pannalam. Mohan is having a stone pa, okay va? Mohan is having a stone. I want to purchase that stone from Mohan, okay va? He is having that stone. I want to purchase that stone from Mohan. Ipo enna agudana, what I am telling, hey Mohan, you have this stone, right? O kaiyila or stone irudha, I just want that. Avana solra venappa, like idu enakku okay va? Some my great father they have given me. What I am telling, see what is the value that you want? You just ask me. Avana sonna சரி ஓகே, யூ ஜஸ்ட் கிவ் மீ ஒரு எனக்கு செலவுக்கு 2000 ரூபாய் தான், ஐ எம் கோயிங் டு கிவ் யூ தட் ஸ்டோன். ஸோ வாட் ஐ டிட், அந்த 2000 3000 rupees அவன் 2000 கேட்டான். என்ன சொன்னேன், அவனை ஹாப்பி பண்ணுறதுக்கு ஐ கேவ் ஹிம் 3000 rupees. யூ டேக் 3000 rupees. அவன்கிட்ட இருந்து நான் அந்த ஸ்டோன் வாங்கிட்டேன், ஓகேவா? ஸோ நான் மோகன் கிட்ட இருந்து அந்த ஸ்டோன் வாங்கிட்டேன். ஸோ நவ் வாட் இஸ் த வேல்யூ ஆஃப் தட் ஸ்டோன்? 3,000 rupees. Correct? The value, who has decided the value? Mohan has decided the value of the stone as 3,000 rupees. Okay, va? Ipo ide stone, I am going and selling to Vijay Lakshmi. I am going to Vijay Lakshmi. Hey Vijay Lakshmi, this is the stone. Okay, va? This is the stone. Okay, va? How much you will pay? How much you will pay? Ava on the stone ke edho advertisement paatru, maybe she knows the value of the, maybe she knows the value of the stone. Okay va, na enna solren, idu romba antique piece pa. This is an antique stone. It is a very rare stone. It is one piece in the world. Okay va, appo Vijay Lakshmi, assume Vijay Lakshmi is married, ava husband kitta kekra, husband, I want to purchase this stone. Appo what I am quoting as the value is, I am selling that stone, I am telling that this stone is actually worth 1 crore rupees, but just for Vijay Lakshmi, I will give it at 80 lakh rupees, 20 lakh rupees discount. Purida. So the value of the stone is 1 crore rupees, but just for Vijay Lakshmi, I am going to sell the stone for 80 lakh rupees, 20 lakh rupees discount. Yana, actually, it is a tactic. Whenever you are selling any goods to ladies, you just add a word called discount. They will get excited. Wow, discount. That to 20%. They will go and purchase. Okay, va. Not knowing what is the worth. Nama Sarvana stores, if you just see 70 to 80% discount, next day all the ladies will be running pa. And males will be following. Okay. So, this, my sale tactic was, I am going to sell to Vijay Lakshmi, 1 crore rupees is the worth of the stone and 20 lakh rupees is the discount. So 80 lakh rupees is the value. Okay, va? Then she got very interested. No, any cost, I want this. But there is one more thing. Ladies are very good at bargaining. Okay, va? The next question Vijay Lakshmi is telling, can you give me at 50 lakh? Appadinu or question. Na enna sonna, 1 crore rupees product, direct 50% kammiya kekringa. What is this? Idu nyayama? No. Seri, or 70 lakhs pa, okay va? 30 lakh rupees discount I can get, or 70 lakh. See, a negotiation is going on. Actually, in any market, negotiation will happen, except it's the stock market pa, okay va? It is good that negotiation is not allowed in stock market. Illana, Reliance share is trading at 2,000 rupees. Girls will go and they will put their order in 1,500 rupees. Na 1,500 rupees ata vaanguva. So, ipan the stone ke negotiation is happening. So 70 lakh rupees, okay va, 70 lakh rupees. Last time I solra illa enakku 50 la da venu. Na enna sonna, seri ungalukku illa enakku illa, 60 lakh rupees final deal done. Okay va. Vijay Lakshmi was also happy. Vijay Lakshmi's husband was also happy. Seri pa, nalla vela 1 crore rupees ke 65 lakh aichi, 60 lakh aichi. Okay va. Then 60 lakh rupees I sold that stone. Now what is the value of that stone? Hello? Purida. The value of the stone is 60 lakh rupees. Purida. The value of the stone is 60 lakh rupees. See, till now I am not talking what is the actual value of the stone. Now, ipo actual value patti pesuvelu, okay va? The value is the price at which it is trading in the stock market, or at which it is having a transaction, okay va? If that is having some transaction, a value is getting assigned, okay va? So first transaction happened for 3,000 rupees. So the value of the stone was 3,000 rupees. The next transaction was happened at 60 lakh rupees. So the value of the stone increased from 3,000 to 60 lakh rupees. The next is Vijay Lakshmi will show off to her friends. Idu 2 crore rupees stone theriyuma. Idu 2 crore rupees stone enage husband vaangittu kodutanga. Aprita, okay va, idu 2 crore rupees stone. Appana this value is inflated to 2 crore rupees because everyone is under an impression that the stone value is 2 crore rupees. But who knows that the actual value of the stone is just 3,000 rupees or 60 lakh rupees or actually nothing pa. Okay va. So the next thing is value is in air. Purida. So my point is that where is the value? Value is in air. There is no such thing called as value which can be assigned. Purida. See, I am just trying to confuse you. Ipo you all were having an impression ஒரு பொருள் அதுக்கு ஒரு வேல்யூ இருக்கும். ஓகேவா? You all were having this underlying assumption. If you have a product, which means you have a value for that product. But what I am telling is, any value that you see is actually fake. There is no value that is real. Okay, va? If you are telling that the price that I'm quoting is 1 crore rupees, that the price that I'm quoting is 2 crore rupees, everything is fake. Okay, we don't have any real value that is existing in the real life. அப்படின்னு நான் சொல்றேன்ப்பா. Do you all agree this? Do you all agree this? See, நான் எப்படி கன்வின்ஸ் பண்ணி விட்டுட்டேன். You all agree, right? That anything, இப்போ நாளைக்கு நீங்க ரிலையன்ஸ் ஷேர் வாங்குறீங்க, ஓகேவா? The price of the Reliance share is 2500 rupees னு வெச்சுக்கோ. The 2500 rupees is the fake value னு நான் சொல்றேன்ப்பா, ஓகேவா? Like 2500 rupees is the fake value. Today you are purchasing the Tata Power share. The Tata Power share is suppose 350 rupees. That 350 rupees is a fake value. புரியுதா? இதே மாதிரி நீங்க whatever you are purchasing, ஓகேவா? Whatever is the value that you are assuming, it is the fake value is something that I have convinced you and I am telling you, and you all have agreed. Now we have a counter argument for that. Okay, we have a counter argument for that. This argument, in the argument Nobel Prize கொடுத்திருக்காங்க, ஓகேவா? What is the counter argument is there? Whatever is the value, ஓகேவா? Whatever is the value that is there in the market, whatever value that is there in the market, it is the real value. And இதுக்கு பின்னாடி நிறைய ப்ரூஃப்லாம் கொடுத்திருக்காங்க. See, actually, if I were to tell you, if I were to, go inside and find out how I derived the value of 3060 lakh, it is just based on the information, okay va? Inna ulla ponga, how I derived value 3000? Because he had one information that this stone is given by their grandfather or by great grandfather. That is the information, and the information I paid in 3000 not for the product. Purida. And what information I gave to Vijay Lakshmi, that this is the antique product, one and only product in the world, okay va? For that information she paid 60 lakh rupees. So the value is not there for the product, the value is there for the information. So if a Reliance share the price is 2500 rupees na, that is not the value of that share, that is value of the information. All the information is getting discounted and then the price is trading in the market. Purida. Yes. So the next thing is, if somebody is asking you how the value is derived na, the value is derived by the information that one person is perceiving. அதனால தான் நான் சொன்னேன், எப்படி நம்ம சொல்றோம் beauty lies in the eyes of the beholder, அதே மாதிரி the value is derived by the person who is valuing. The person who is valuing, based on what information he is having, he will value that share. Correct? Now I am having the information. If I am having the information that Mukesh Ambani is in hospital, he is just living his last breath, okay, and mari if I have an information na, I know that tomorrow Reliance share will fall, okay va? If this news comes in the newspaper, tomorrow Reliance share will fall. So what I am doing, I am selling all my shares today. So if I am selling all my shares today na, which means I am actually perceiving a lesser value. Why I am perceiving a lesser value? Because I am having some information that you guys are not having. Purita, this is called as insider trading, okay va? That is not allowed actually, but I am just telling you an information. So if I am having some information, the information is a secretive information that, okay va, something happened to him and it is his last day. And the mari or information enakku kedaikudana, I know that the next day market will fall heavily, okay va? Or 30-40% fall achi irukku, okay va? Because the chairman, okay, but the chairman of a very big group, if he's out na, it is a very bad news and it will be a very negative sentiment, okay va? Then what will happen? The price will fall. Then when the price is falling, then I will purchase and I made a profit. Purida. Now what I did, 1 crore share I sold. When the share went from 2500 to 1500 rupees, again that 1 crore share I have purchased. Aprina, I made a profit of 1000 rupees into 1 crore, which is 1000 crore rupees. 1000 crore rupees is the value of the information that I had. Purida. So the value of something is based on the information that is getting discounted. Now we have a model, okay, we have a model and we have a theory. And the theory enna solludana, whatever is the price which is trading in the market, okay, which is trading in the market is the value of the information that is discounted to all the public. Are you all understanding? So nama adala paapola profit, EPS adala, but actually neenga pathingana, that is one factor, that is one information, that is one of the information in the profit, EPS, in the costing, what is the next project, annual report, all these are one of the information. There is something called as qualitative information, we have something called as quantitative information. After discounting, okay va, we can only discount numbers, but qualitative information can also be discounted. That's a theoretical concept. So after discounting all the information, we will derive a value that is called as the actual value of the share. That is called as the actual value of the share. Even in the inter syllabus and even in the final syllabus, finding out the actual value of share is not there in the syllabus. That you are going to study something after you become a CA. How to find out the actual value of the share, that you are going to study something after final. அப்போ intern level நீங்க என்ன சார் பார்க்க போறோம்னா, ஒரு குவான்டிடேட்டிவ் பேசிஸ்ல how will I find out the value of the share அதான் நீங்க பார்க்க போறோம். புரியுதா? இப்போ why I have given so much introduction, why I stressed so much on the value of the share is that you should have this, you should have this level of maturity that tomorrow if somebody is asking you the value na, சும்மா numbers basisல நீ ரொம்ப கான்ஃபிடென்ட்டா சொல்லக்கூடாது. ஒரு நம்பர்ஸ் வச்சுட்டு நீ ஒரு கால்குலேட் பண்ணிருக்க that this is the value of the share, I am very confident this is the value of the share. Tomorrow you should not go out and purchase all those shares saying that it is undervalued, because not only quantitative factors should be discounted but also qualitative factors should be discounted. Otherwise you will go into the stock market and then you will lose money. Yes. Sumar practical example I am telling you. So now coming back to the subject. In this subject we are going to study how to find out the value of the share on quantitative basis. Quantitative basis na the numbers which are available in the books of the accounts, and the basis la நம்ம ஒரு value assign பண்ணுவோம், that is called as the value of the share. So இங்க நீங்க எப்பவுமே value of the share பாப்பீங்கல, you cannot use that value of the share practically is what I am trying to tell you. So whatever you are going to study is just a book concept. Clear? Okay. Now we have one method. We have different valuation methods. Okay, hundreds of valuation methods. Okay, here also you studied valuation methods, and the constant dividend approach. Using constant dividend you can have one value. Using constant earnings you can have one value. Using dividend growth you can have one value. Either some value you are going to study in dividend decisions also. And one more valuation method is PE ratio that we are going to discuss today. First, what is PE ratio? PE ratio is called as price earning ratio. PE ratio is called as price earning ratio. It is one of the very important ratio which is used for valuing an equity share. It is one of the easiest method to value equity shares. One of the easiest method. We have many valuation techniques. Okay, we have this discounted cash flow technique, correct? We have this and the final we have many techniques. We have this rank technique. In all this technique, what you are going to do is that we will find out the value of the equity shares. One of the technique is price earning ratio, which is also called as PE ratio. Now to explain you what is PE ratio, first formula is nothing but price earning ratio. It is price divided by earnings, which is nothing but MPS divided by EPS. Price divided by earnings, MPS divided by EPS. Price na market price per share, earnings na earnings per share. Okay. Now price earning ratio நம்ம என்ன பண்றோம்னா, நம்ம வேல்யூ இருக்கிற வேல்யூ வச்சுட்டு நம்ம வேல்யூ டிரைவ் பண்றோம். I'll just give you an example. We have a company, okay, company A and company B. Both are similar companies, okay, both are similar companies. Both are not having any difference. Same capital structure, same business, okay, everything is same. The only thing is the size is different. One the size is more. The one is a 1000 crore revenue company, second one is a 10 crore revenue company. That is the only difference. Otherwise everything is same. Profitability, capital structure, okay, the way they are taking decisions, everything is same. Now we have two companies, okay, both the companies are having earnings. Earnings now I'm just writing per share basis, EPS basis, I'm writing the earnings. This is having earnings of 10, okay, this is having earnings. This is called as a small company and this is a big company. So this is having EPS of 10 rupees. Both are having same shareholders, okay, same number of shareholders. So that is the reason here the EPS is 10 rupees and here the EPS is 500 rupees. Here also you are having 100 shareholders and here also you are having 100 shareholders, okay, which means here the earnings is 10 into 100 and here the earnings is 100 into 500, okay. So here my EPS is 10 rupees and here my EPS is 500 rupees. Actually this is listed because it is a big company and this is unlisted, okay. This is not listed and this company is listed. If it is listed now, it is having a market price. This share, okay, this share is trading in the market at 2500 rupees. Okay, but this share is trading in the market right now at 2500 rupees. If I am the investor now, what I am telling, see what is the sentence that I am using. 500 rupees earnings, the shareholders are ready to pay 2500 rupees, which means 5 times of the earnings the shareholders are ready to pay as the market price. Purida, what I am trying to tell. 500 rupees is the earnings. If the earnings is 500 rupees now, the shareholders are ready to pay 2500 rupees for that share. For the company which is earning 500 rupees, the shareholders are ready to pay 2500 rupees, which means 5 times the earnings of the company the shareholders are ready to pay for the company. Purida, that 5 times is called as this price earning ratio. That 5 times is called as P ratio. If you want to find out the P ratio now, it is MPS divided by EPS, which is nothing but 5 times. So how we have to interpret this 5 times is that P ratio is the ratio which the shareholders, okay, which the shareholders are ready to pay times of the earnings, okay. So 500, so if 500 is the earnings and 2500 is the market price of the share now, the shareholders are ready to pay 5 times of the earnings. The shareholders are ready to pay 5 times of the earnings, that is called as the P ratio. Then what should be the value of this share? For this company, if the shareholders are ready to pay 5 times, now if this is the same company, here also they are ready to pay 5 times. Correct? Both are same company. So here also the shareholders will be ready to pay 5 times. Then what is the value that I am deriving here? 50 rupees. So 50 rupees is the value that you derived for the company. That you derived for the company using a surrogate P ratio. Clear? So this is one way of valuing the share. See, how easier you value the share. So this is one of the easiest way to value the share. Actually, in the stock market, people, okay, most of the beginner level people or even a high level people actually value shares using P ratio. And P ratio nariya vechiruvanga, okay, P growth ratio, and the mari nariya P ratios irukudhu. Trailing P ratio, but this is the simple way how to calculate the P ratio. The P ratio is nothing but market price per share divided by earnings per share. That is the P ratio. Using the P ratio, you have valued the company share, which is 50 rupees. The advantage of P ratio is that the first thing is P ratio is one of the easiest way to calculate the value of the share. Second advantage is the numbers which we want to calculate the P ratio are easily available. EPS na you can take it from their annual reports. MPS na stock market open panninga you will get the value. So even today, if you want to find out what is the P ratio of Reliance na, within 1 minute you all will be able to find out. Just take out what is the EPS. EPS is nothing but in the annual report, see what is the earnings per share. What is the earnings per share, and then you take the market price per share, divide that earnings per share, you will get the P ratio. You will get the P ratio. Using that P ratio, you can actually value similar companies and then see whether it is undervalued or overvalued. Clear? Yes. So P ratio clear hai? Okay. So what is the formula for P ratio? MPS divided by EPS. Very good. Now ஒரு test. In the last class நம்ம value of equity க்கு 4 formula பார்த்தோம், கரெக்டா? 4 formulas நம்ம பார்த்தோம். So can you all tell me those 4 formulas? First one, பார்க்காம, don't see the textbook, from your memory you tell me. What is the first formula? Constant earnings approach. Constant earnings approach. What is the formula? EPS divided by MPS. Second one, constant dividend approach. Okay, what is the formula? DPS divided by EPS, huh? D divided by, okay, but D divided by P0, or you can also write as DPS divided by MPS. Okay, but dividend per share divided by market price per share. D divided by PO. Third one, I want unanimous, but why this side is very silent? Dividend growth approach. Okay, so DGM, dividend growth model. What is the formula? D1 divided by P0 plus G. This is the most important formula. 90% of the problem use this formula. Okay, wa? Dividend growth model. D1 divided by P0 plus G. G can be calculated as retention ratio into return on equity. B into R. Okay, wa? B into R. Fourth one, what is the formula? Capital asset pricing model, which is CAPM. So what is the formula? RF plus beta into RM minus RF. Clear? All these are K formulas. K in a cost of equity. In the 4 formula, if you have clarity na any problem, okay, even from these 4, this is the formula that is used in 90% of the problem, which is dividend growth model. If here you are going to see that this EPS divided by MPS is nothing but the inverse of P ratio. P ratio is MPS divided by EPS. K is EPS divided by MPS. So I can tell that K is also equal to 1 by P ratio. Can I tell like that? Correct? Yes? Okay. Which means I can find out the market. This is what is called as value of the share. Correct? Market price of the share. Correct? So I can find out the market price of the share if I have KE or if I have P ratio. Purida. Ippo, the next thing is, now the EBIT, EPS, MPS analysis on correct? There the end point was EPS. What was the end point? Earnings available to equity shareholders divided by number of shares. Divided by number of shares, you are going to get EPS. Ippo, in this EPS, if I multiply P ratio, I will get MPS. Correct? Yes or no? So from EPS, if I multiply P ratio, EPS if I multiply P ratio, I am going to get something called as MPS. MPS is nothing but the value of the share. Or, okay, or in the EPS, if I divide that with KE, I am going to get MPS. If you have P, if you have KE, if K is given, first you calculate P ratio. P ratio is nothing but 1 divided by KE. And then you multiply it with P ratio. Any method you do, it is okay. Okay, any method you do. The best way is to P ratio, and conceptually it is very easy to understand. Earnings ka how many times I have to pay to called as MPS. If P ratio is directly given, multiply EPS into P ratio. If P ratio is not directly given, K is given, using K first find out P ratio. So P ratio is equal to 1 divided by K. If K is 20%, what is P ratio? ரொம்ப டஃப் கொஸ்டினா 5 times கரெக்டா எல்லாருக்கும் கால்குலேட் தான 1 divided by 20%. What is the answer? 1 divided by 0.25 times, correct? So first using that KE you find out P ratio, then using that P ratio you multiply and then find out the market price per share. From there you are going to get EBIT, EPS and MPS analysis. Clear? Clear? Really, are you all understanding? Yes. So which means in the EBIT, EPS, MPS analysis நம்ம எப்படி பண்ணனும்னா, it will start with EBIT minus interest, I will get earnings before tax, minus taxes, I will get earnings after tax. If preference dividend is there, then minus preference dividend, I will get earnings available to equity shareholders divided by number of equity shares. I am going to get EPS multiplied by P ratio, I am going to get market price per share. Wherever the market price per share is maximum, that is the ideal capital structure. Clear? Now direct P ratio அப்படியே முடிச்சிடலாம். P ratio is nothing but the ratio which is having a formula price divided by earnings. அப்படி சொல்லிட்டு நான் முடிச்சிடலாம். Why I have given you so much information of value of the equity and then P ratio, so that you all should understand the essence behind why market price per share is important, and you know why this P ratio is a very important ratio. இல்லனா அந்த value எப்படி P ratio is used to find out the value of the share and the maturity to understand that value varna. If you are just formula oriented, P ratio ka formula is P divided by E, price divided by earnings, MPS divided by MPS price, MPS divided by EPS. அப்படினா உங்களுக்கு ஒண்ணுமே புரியாதுப்பா. ஓகேவா? வேல்யூ na என்னது, actually அந்த clarity வராது. Now I hope you all got that clarity of what is the value of the share and what is the importance of P ratio. Yes or no? Yes? Okay. So in this format, if you do any problem, you are going to handle on EBIT, EPS and MPS analysis. Shall we do some problems? Can someone give me a study material, please? இல்ல ப்ரொஜெக்டர்ல போடலாமா? இன்னும் எவ்வளவு டைம் இருக்குது? till half an hour. அப்ப ப்ராப்ளம் போடலாமா? நெக்ஸ்ட் டிஸ்கஸ் பண்ணிடலாமா? நம்ம பண்ணலாம்ப்பா. ப்ராப்ளம்ஸ் நம்ம நெக்ஸ்ட் டே போடலாம். Okay, one problem we are going to do today and then I am going to start. So give me the study material. ஏன்னா ப்ராப்ளம் பண்ண உங்களுக்கு கிளாரிட்டி வரும், அதர்வைஸ் யூ வில் ஃபர்கெட் எவ்ரிதிங். நெக்ஸ்ட் டே வரும்போது சார் நம்ம படிச்சோம் ஆனா ஞாபகம் இல்லை, லைக் திஸ் யூ வில் ஃபீல். சரி, everybody is having the textbook, right? இல்லனா நான் ப்ரொஜெக்டர் போட்டு டெக்ஸ்ட் புக் போடணுமா? Everybody is having? Okay, everyone take out page number 5.34, illustration 11. No one is having a here first row textbook. See, all these are very easy, okay va? அதை நான் பண்ண மாட்டேன், நீங்க தான் பண்ணணும், okay va? I'll just dictate. Illustration number 11. Everyone is having textbook, right? Okay, how many of you are not having textbook? I mean, Ippo, you don't have, even you or your partner is not having. Okay. Then you sit with a partner who is having a textbook. Okay. Now, illustration number 11. Suppose that a firm has an all equity capital structure consisting of 1 lakh ordinary shares of rupees 10 per share. This is called as existing. Whenever you are reading a question, now here again I am telling you an approach. Whenever you are reading question based on EBIT, EPS, MPS analysis, first thing that should come in your mind is what is existing and what is new. Okay va? ஏன்னா எக்ஸிஸ்டிங்னா அது யூ ஷுட் பி ஹேவிங் இந்த கேல்குலேஷன், நியூனா அது நீங்கள் கேல்குலேஷனை ஒர்க்கிங் நோட்டாக போடணும். ஓகேவா? இப்போ எக்ஸிஸ்டிங் ஈக்விட்டி ஷேர்ஸ் 1 lakhனா விச் மீன்ஸ் நியூ ஈக்விட்டி ஷேர்ஸ் யூர் இஷ்யூயிங்னா இட் வில் பி எக்ஸிஸ்டிங் பிளஸ் நியூ அப்படிதான், and then that will be a total number of shares and then you have to calculate EPS. Many students do this mistake. In the existing equity மறந்துடுவாங்க. To calculate EPS they will just divide the number of new equity shares and then they will calculate the EPS, and that is the wrong thing. So the first approach is that first you have to see what is the existing capital structure, whether they are having any debt, whether they are having any equity. Then இப்போ debt இருந்தாலோ existing interest and additional interest அந்த மாதிரி you have to write. கரெக்டா? First it will be existing interest then additional interest. இதே மாதிரி கீழே வரும்போது existing shares and new shares, and then you have to do total number of shares divided by EPS. Clear? So that is the approach. Suppose that a firm has an all equity capital structure consisting of 1 lakh ordinary shares of rupees 10 per share. The firm wants to raise 2,50,000 rupees to finance its investment and considering 3 alternative methods of financing. So the new financing needs is 2,50,000 rupees. And existing they are having some 10 lakh rupees, which is 1 lakh into 10. Okay. Now 3 methods. First is to issue 2,500 ordinary shares at rupees 100 each. That is option number 1. Option number 2, borrow 2,50,000 rupees at 8% interest. Third one, issue 2,500 preference shares of rupees 100 each at an 8% rate of dividend. So 3 alternatives. First is you raise it through equity. Second is you raise it through debenture holders. Third one is you raise it through preference shareholders. If the firm's earnings before interest and taxes after additional investment is 3,12,500 rupees, which is called as the new EBIT. Here again the approach will be what is old EBIT, what is new EBIT. Here new EBIT is directly given. In usually some questions new EBIT will not be directly given, old EBIT will be given, and then additional what is because of this project what is the earnings, then you have to add both the EBIT and then you have to solve. Okay va? இல்லனா ஏதோ ரேஷியோ கொடுத்துருவாங்க, கேபிட்டலைசேஷன் ரேட் கொடுத்துருவாங்க, ரிட்டர்ன் ஆன் இன்வெஸ்ட்மெண்ட் கொடுத்துருவாங்க. By that you have to calculate something called as new EBIT. Okay va? So new EBIT is 3,12,500, tax rate is 50%. Find the effect on earnings per share under the 3 financing alternatives. Now draw a column, particulars option 1, option 2, option 3. Do it pa. Particulars option 1, option 2 and option 3. It is always a good practice. Actually, see, this is an easy question, adala ungalku puriyadu, but it is always a good practice to write what is there in option 1. So first, you can write below option 1, you can write 25,000 equity shares at rupees 10 each. So which means you are going to get to know that okay, 25,000 shares are there. Okay va? So below option 1, you write 25,000 equity shares at rupees 10 each. Debt, you directly write the amount, rupees 2,50,000 at 8% interest rate. And preference shares, you write rupees 2,50,000 rupees at 8% preference dividend. இப்போ உங்களுக்கு புரியாத why I'm asking you to write, ஆனா இதே இதோ அட்வான்ஸ் கொஸ்டின் வந்துச்சுன்னா you are going to understand. ஏன்னா in many options there can be multiple things, maybe 10,000 equity shares, 2,000 debenture holders and 3,000 preferences அப்படி இருக்கும். ஓகேவா? So there only if you write you will get the clarity, otherwise every time you have to read the question. Clear? So below option 1 you write 25,000 equity shares at rupees 10 each. Below option 2 you write 2,50,000 debt at 8% interest, and below option 3 you write 2,50,000 rupees preference at 8% dividend. Okay, then you can just draw a line to start the table, right? EBIT is same in all the three cases: 3,12,500, 3,12,500, 3,12,500. Then minus interest, that will be profit before profit before taxes. Then less taxes, you are going to get profit after taxes. Then less preference dividend, earnings available to equity shareholders divided by number of equity shares. Completed, huh? Next class completely will be doing problems, because we are going to do problems on cost of capital also, and then we are going to do problems on capital structure also, and then we will continue the other concepts of capital structure. Done, completed. Okay, what is the EPS? 1.5. Okay, for plan A what is the EPS? 1.25. okay va? For plan B 1.36. everyone getting the same answer? Okay, how many of you got a different answer? Okay, everyone got the correct answer, huh? 1.25, 1.46 and 1.36. very good, pa. Okay, very good. Now which option of financing is the best financing? Option 2 is the best financing. Okay, option 2 is the best financing. Now option 2, what is option 2? All debt. Correct? All debt is the option 2. அப்படினா இங்க நீங்க பாருங்க, here also all debt is actually is the best way of financing in the equity. okay, by in the equity side. Next thing is to find out the market price per share. அவங்க என்ன சொல்லிருப்பாங்கன்னா இந்த क्वेश्चनல P ratio கொடுத்திருப்பாங்க. ஓகேவா? P ratio கொடுத்துருவாங்க. So here in this question what they are telling, if the company is the all equity ratio, people are ready to pay 10 times of the earnings. Okay, but people are ready to pay 10 times of the earnings if all equity. If it is all debt, now people are ready to pay 8 times. People are ready to pay 8 times of the earnings. If it is all preference shares, the people are ready to pay 7 times. 7 times of the earnings. So that is the P ratio. P ratio in all the 3 cases. If it is option 1, it is 10 times, option 2 8 times, and option 3 is 7 times. Now the next thing is you have to find out something called as market price per share. How to find out market price per share? EPS into P ratio. Clear? So market price per share. What is the market price per share here? 12.50. Here what is the market price per share? 11.68. Here 9.52. 9.52. Now the next thing is inga neenga parunga, just see what is happening whenever, okay va, as you said that wherever the weighted average cost of capital is lower, that is the best financing. Okay va, first நம்ம அப்படிதான் ஸ்டார்ட் பண்ணோம், கரெக்டா? And then I gave an argument, wherever it will be 100% debt, there it will be minimum weighted average cost of capital, but whenever it is 100% debt, we are having a high financial leverage. So that is the reason அதை நம்ம choose பண்ண முடியாது. ஓகேவா? அந்த ஆர்குமெண்ட் நம்ம பண்ணோம், கரெக்ட்? Now whenever we are doing EBIT, EPS, MPS analysis, and the EPS calculate பண்ணும்போது, if it is debt na equity shares will be less, if it is equity na equity shareholders will be more. So if it is all equity, which means the denominator will be more, that will bring down my EPS. புரியுதா? But if it is debt na, your denominator will be less, that will increase your EPS. புரியுதா? I will repeat again. All equity na, your number of equity shares will be more, number of equity shares will be on the denominator. If your denominator is increasing, your EPS will reduce. Correcta? Same way, if your denominator is reducing, your EPS will increase. If all debt irda, your denominator will be less, and when your denominator is less, your EPS will be more. So even using that argument also, all debt looks better. Purida? You know, all debt always your denominator will be less. Correcta? So that is the reason inga pathina, usually I'm not telling always, usually under EBIT EPS analysis, usually in the EBIT EPS analysis, all debt will be having highest EPS. All debt will be having highest EPS because their denominator will be less. But whenever debt is there, risk inga inno risk factor varla, correct? And the leverage factor inno varla. This leverage factor is coming through P ratio. எப்படின்னா, if it is all equity na, my equity shareholders are actually safe. அவங்க என்ன சொல்றாங்க, சரி அந்த earningsக்கு 10 times நான் பே பண்ணதுக்கு ரெடி. ஆனா debt holders உள்ள வந்துட்டாங்கன்னா, the shareholders are little cautious because my financial fixed cost is high. அப்பனா I will not pay 10 times, I will only pay 7 times. So they have made the price cheaper. புரியுதா? So in the P ratio 10 times to 8 times ஆகுதுன்னா, which means the shareholders are feeling that it is little risky to invest in a company which is having a high financial leverage. Adunala this P ratio is getting reduced. Correct? Are you all understanding? And again preference share இருக்கும்போது again அவங்க 8 times வந்து 7 times பண்ணிட்டாங்க. ஓகேவா? Because that is also having a financial leverage. இப்போ here if you see, once you inculcated the risk in a P ratio, using P ratio I am actually defining the risk of the company. Actually what is K? K is nothing but the cost of equity. P ratio is nothing but the inverse of the K. Correct? So K is nothing but how much the shareholders, the return is expected by the shareholders, that is called as K. K is nothing but the return that is expected by the shareholders from the company. That is becoming the cost of the company. The return that is expected by the shareholders is becoming the cost of the company. Using that P ratio, here if you see the P ratio is falling. Why the P ratio is falling? You have to understand the concept. The concept is that the equity shareholders are feeling little risky to invest in a high financial leverage company. That is the reason they are paying less. That is the reason they are making the share cheaper. In the 10 times, in the 8 times பண்ணும்போது, if the P ratio is reducing, the share price is getting cheaper. Why the share price is getting cheaper? Because of the risk that is increased. So as and when you inject debt into the company, the financial leverage will increase and the risk will increase. If the risk is increasing, the equity shareholders will expect more return, which means KE will also be increasing. Purida? Now find out what is KE here. What is KE here? One divided by 10, 10%. 1 by P ratio is the KE. Here what is the KE? 12.5%. Here what is the KE? 14.28%. இப்போ நல்லா கவனி. See, concept புரியுதா? Interest, see, actually problem over pa, okay, problem over. But this is something after problem concept discussion. இங்க பாரு, it is all equity, okay, when it was all equity, my P ratio was 10 times. இப்போ இந்த when I injected debt into the company, the equity shareholders felt that now it is risky for me to invest in the company. That is the reason they made the share price cheaper. While telling that, I can also tell that the expected return of the equity shareholders is getting increased. In an all equity company, the shareholders are expecting 10%, but when I'm injecting debt into the company, now my shareholders are asking, if 10% venappa, if 12.5% venum. Purida? So now the equity shareholders are expecting 12.5%, which means the KE is increasing as and when you are injecting debt into the company. இதுதான் பண்ணி net operating income approach ல பார்க்க போறேன். So I'm just linking each and everything. In net operating income approach ல same thing will happen. As and when you inject debt into the company, your KE will increase. Okay? So this is something that you're seeing, practically in this here also. So if you see using MPS, which one you will choose? Using MPS, which one you will choose? Option 1. Why option 1? Because here the market price per share is highest. Clear? Are you understanding? Unniya concept purida? Yes? Okay. How to solve the problem you are all understanding? Correct. You all are listening to me? Yes. Very important. You all are understanding? Yes. சரி. Now நம்ம என்ன பண்ணலாம்னா இன்னொரு ப்ராப்ளம் போடலாம். இதுல இருந்து இன்னொரு ஸ்டெப் அட்வான்ஸ்ட், ஓகேவா? ஒன் மோர் ஸ்டெப் இஸ் ஆக்சுவலி ஒன் மோர் லேயர் இஸ் தேர் அந்த ப்ராப்ளம்ல. Take out illustration number 12. Okay, this was illustration number 9, correct? Take out illustration number 12. Best of luck Limited, a profit making company. If the company is lucky, it is always a profit making company. So Best of Luck Limited, a profit making company, has a paid up share capital of rupees 100 lakh consisting of 10 lakh ordinary shares of rupees 10 each. So which means existing they are having 10 lakh shares. Apdi you have to read, okay? So existing you are having 10 lakh shares. Currently it is earning an annual pre-tax profit of 60 lakh rupees. So this is current profit, okay? But this is current EBIT. So annual pre-tax profit of 60 lakh rupees. The company shares are listed and are quoted in the range of 50 to 80 rupees. So right now the share is quoted in the range of 50 to 80 rupees. The management wants to diversify production and has approved a project which will cost 50 lakh rupees. Which means under 50 lakh rupees is the new financing that they want to raise. And which is expected to yield a pre-tax income of 40 lakhs per annum. So in the project, what is the earning? 40 lakh rupees. Existing, what is the earning? 60 lakh rupees. So overall, your EBIT will be, okay, 100 lakh rupees, which is 1 crore. Clear? Okay. To raise this additional capital, the following options are considered. The following options are under consideration. So here also A, B, C, 3 options are there. Option number A, to issue equity share capital for the entire additional amount. For the entire additional amount, it is expected that the new shares can be sold at a premium of 15 rupees. Then the new shares are sold at a premium of 50 rupees. So what is the additional investment? 50 lakh rupees. 50 lakh rupees is issued at 15 rupees. So how many equity shares? 50 lakh divided by 15. How many equity shares? 1 minute. Face value 10 and a premium of 15 rupees. Sorry. Inga paranga, nariya people will make a mistake. Premium of 15, it is issued at 50 rupees. Issue price is different, premium is different. So face value 10 rupees, premium 50 rupees, which means it is issued at 25 rupees. Clear? Yes? So this is one mistake that many students will make. So you have to see, we have to see whether is it an issue price or is it a premium. Okay, ba? So premium 50 rupees, face value 10 rupees. So issue price is equal to face value plus premium, which is 10 plus 15, which is 25. So 50 lakh divided by 25 is equal to 2 lakh shares. Next option, to issue 16% non-convertible debentures of rupees 100 for the entire amount. So which means the next is 50 lakh rupees at 16% debentures. Okay, at 16% interest. The next is 50 lakh rupees they are raising at 16% interest. Third option is issue equity share capital for 25 lakh, face value of 10 rupees. Okay, face value of 10 rupees and 16% non-convertible debentures for the balance amount. So first, what is the balance amount? 25 lakh. 25 lakh equity, 25 lakh is the balance amount. In this case, the company can issue shares at a premium of 40 rupees. So their premium was 50 rupees. Here premium is 40 rupees. So in the third option, they are issuing this 25 lakh rupees at 40 plus 10, which is 50 rupees. Clear? So which is 25 lakh divided by 50, which is 50,000 shares. Okay, 50,000 shares and balance 25 lakh, 16% non-convertible debentures. Otherwise, which option is the most suitable to raise the additional capital? Keeping in mind that the management wants to maximize the earnings per share. So EPS should be maximum to maintain its goodwill. The company is paying income tax of 50%. The company is paying income tax of 50%. Question purinjada? Everyone clear? Yes? Okay. Now write the solution. Illustration number 11. Illustration number 12. Illustration number 12. Particulars option 1, option 2, option 3. Particulars option 1, option 2 and option 3. Below option 1 you write. Below option 1 you write. How many equity shares? 2 lakh. So you write 2 lakh equity shares at rupees. Okay, at rupees 25. Next option 2, rupees 50 lakh debentures at 16% interest. And below option 3 you write 50,000 equity shares at rupees 50 each and 25 lakh rupees debentures at 16% interest. This is the basics that you are writing so that you don't have to see the question again and again. Done. Now you just put a line and write EBIT. EBIT, if you have two EBIT, write existing EBIT and additional EBIT. So existing EBIT is 60 lakh rupees. So write 60 lakh in all the cases. And the new EBIT, additional EBIT, you write 40 lakh rupees in all the cases. Then total EBIT is equal to 1 crore rupees. And the money you have write. Okay, 1 crore rupees. I want everyone to write pa. Then less interest. If now existing they are not having any interest, correct? So that is the reason you just write less interest. Illana interest la kuda there may be a possibility we have existing interest and additional interest. So here we don't have any existing debentures. Existing is only capital. So less interest. In the first case you don't have any interest because everything is equity. You just have to read the option 1. No debentures, so no interest. Second one, 50 lakh rupees into 16%. Third one, 25 lakh rupees into 16%. So which will be 8 lakhs and 4 lakhs. Then profit before tax minus taxes, profit after tax divided by number of equity shares. In number of equity shares, first you write existing number of equity shares and then additional equity shares, then total number of equity shares, and then PAT divided by number of equity shares will be your EPS. So calculate and tell me what are all the 3 EPS. அவ்வளோ சீக்கிரமா பிடிச்சிட்டிங்களா? Any problem? No, right? You have only one problem, which is illustration number 12. Any other problem, please discuss with me. I am good in finding solutions. Actually, yesterday it was my class. I was ready. Okay, I will come yesterday. I will take class. But severe cold. Night 2 o'clock I messaged and tell I am not going to come. When you got an information that the class is cancelled? 4 o'clock. Morning 8:30 dana. Oh, class. Ella class ko vanditinga and then you got an information the class is cancelled. So sad. Then what you did? Purila. Time pass. Group discussion. கதை பேசிட்டு இருந்தீங்க. நான் நைட் ஒரு 2:30 AM நான் மெசேஜ் பண்ணியிருப்பேன். பா ஐம் சாரி, ஐ எம் ரியலி அன்வெல், நான் இப்போ வரவே முடியாது, ஐ எம் நாட் ஏபிள் டு டேக் தி கிளாஸஸ். இப்போ கூட லிட்டில் பிட் ஓகே ஐ எம் அன்வெல், பட் ஃபார் மை ஸ்டூடெண்ட்ஸ், ஃபார் மை வேலண்டைன்ஸ் ஐ ஹேவ் டு கம், ரைட்? சரி, கம்ப்ளீட்டடா? How many of you are still doing? Please raise your hands. How many of you are still doing? How many of you are still doing the problem? Everyone completed, huh? Super. Okay. What is the EPS in the first case? 4.167. Okay. Second case? 4.6. Third case? 4.57. Everyone is getting the same answer. Anyone who got a different answer? No one. See, na evlo nella solli kudikra. Everyone is doing all the correct answers. So EPS, now using EPS, which is the best financing option? Option 2. I already said you, whenever you are doing the EPS and the all debt kada eppume, it will be given more priority. But still EPS is 4.6. Clear? EPS is 4.6. So option 2 is the best financing. Option 2 is the best financing. If this is a 5 mark problem, 4 mark is given for this. Still you will lose 1 mark if you are not writing the sentence as per and the sentence. So I am just giving you many students. See, it is my habit to tell mistakes. Only if I tell mistakes, you will be able to learn from those mistakes. Many students do this mistake of avanga enna exam hall la oh got the answer, tick, and then they will illana circle pante they will just go. So this is not the right way. You have to write this sentence. It is advisable to go for option number 2 because in that case the EPS is maximum and the sentence, okay, but that sentence gives you 1 mark. If you are not writing that sentence, you won't get that 1 mark. Same way, what many students do, one more mistake is that inga divided by number of equity shares போடுறோம்ல அங்க existing share add பண்ண மாட்டாங்க ஓகேவா. that is one more mistake. இப்போ I told you, so you guys did, but in the exam hall, or this is the common mistakes that student do. இங்க divided by number of equity shares பண்ணும்போது they missed, okay, but they missed to add the existing shares. New shares மட்டும் divide பண்ணிட்டு they will calculate EPS and then that will be a wrong answer. So new shares plus existing shares. அதனால தான் whenever you are reading the problem, already for any problem you should have an approach. Investment decisions, நம்ம investment decision problem read பண்ணும்போது நான் approach சொல்ல. What was the approach in investment decision? Any problem you are doing, you just have to think in 3 ways. What is initial capital outlay, what is annual cash flow, and what is terminal cash flow, and what are all the adjustments. If working capital that is adjusted in 2 places. So and the problem read பண்ணும்போது if you are having the correct approach, then the solving the problem becomes very easy. That is the only value addition. Okay, well, I mean that is not the only value addition, that is one of the value addition that you are going to get from this revision class is to how to approach the problems. Okay, well, once you know the right approach to problem na, the solution will be much smoother. This applies in real life also. Any problem you get, the approach to the problem should be clear, so that and the solution smooth irko. So in this case, okay, well, in this case writing this sentence will secure you 1 mark. Again, 2 common mistakes. One common mistake is that the number of equity shares, existing number of equity shares, they will forget. The second common mistake is that on the EBIT irkola, okay, well, EBIT they will directly put 40 lakhs only. They will not put 60 plus 40, and the 60 existing and 40 is the new, right? They will not put 60 40, they will directly put EBIT 40 lakh and then they will solve the problem. So these are the 2 mistakes that many students make. So avoid, okay, well, avoid those mistakes. Clear? Yes? Okay. Next, illapa, listen to me first. Illustration number 13. Next illustration number 13, you guys have to do homework. Okay, va? Don't be so impatient. Sir, break. This is not a class. The bell adichitha and then you just have to go. So illustration number, actually whenever someone asks me break na, you know I am a sadist person. Theriyum. So illustration number 13 dana ama. Illustration number 13, you have to do it homework. Okay, va? Now illustration number 13 la we have one more additional point. I just discuss that point with you and then the class is completed. Okay, va? Yes, happy? Yeah? You should be sad. Sir, we are leaving you. But still. See, now avlo kashtabad. even I am unwell, I am coming, I am taking classes, and you guys are becoming happy. Very sad, I am very sad. Illustration number 13. Illustration number 13 la the additional point is that கவனிங்க, the additional point is that அங்க interest slab rateல கொடுத்திருப்பாங்க. ஓகேவா? சப்போஸ் ஒரு எக்ஸாம்பிளுக்கு if I want to raise 20 lakh rupees னா அவங்க என்ன கொடுத்திருக்காங்கன்னா 5 lakh this is the interest rate, next 10 lakh this is the interest rate, over and above 10 lakh that is the interest rate. ஓகேவா? which means the interest ஒரு working note போடணும். அந்த மைனஸ் இன்ட்ரெஸ்ட் இருக்குதுல அதுக்கு நீ ஒரு ஒர்க்கிங் நோட் போடணும், and that interest you have to calculate using slab rate. So here interest is 50 lakh, here interest is 80 lakh, here interest is 1 crore na, till 50 lakh there will be one interest rate, till 80 lakh there will be one interest rate, more than 80 lakh there will be another interest rate. So adu vechittu you just have to calculate something like income tax calculation. Okay va? So here interest rate slab rate la calculate பண்ணுவாங்க. That is the first. Okay va? That is the one, that is only one layer which is included in this problem. Okay va? That is one additional layer, and the second additional layer என்னது அவ்வளவுதாப்பா. That is the only one layer which is there. ஓகேவா? preference shares is there, அதெல்லாம் ஒண்ணுமே இல்லப்பா. preference shares இல்ல. ஓகேவா? so that is the only one thing that you have to do. So illustration number 13, I want you all to do homework. Okay, will you all do? Okay, so illustration number 13 முடிஞ்சதுக்கு அப்புறம் illustration number 14 பண்ணிருப்பா. ஓகேவா? illustration number 14 பண்ணிரு. illustration number 14 ல one point is there, அது பாயிண்ட் மட்டும் நான் சொல்லிறேன், then you leave. ஓகேவா? then I will leave. கவனிங்கப்பா, group discussion அப்புறமா பண்ணிடலாம். so illustration number 14 ல hello, illustration number 14 ல the point is அவங்க EBIT டைரக்டா கொடுக்கல, அதுக்கு பதிலா what they are giving is that அவங்க return on investment கொடுத்திருக்காங்க. ஓகேவா? so existing what is the return on investment, அந்த இன்வெஸ்ட்மென்ட்க்கு what is the new and the new return, அதை வச்சிட்டு you just have to calculate. ஓகேவா? so first you try on your own, if you are not getting then you see the answer. ஓகேவா? so illustration number 13 and illustration number 14 is the homework that you have to do, then we will close EBIT, EPS, MPS analysis, and then we will move into the next thing. Clear? Yes, ஈஸியா இருந்துச்சா? EBIT, EPS, MPS ஈஸியா இருந்துச்சா? உண்மையா ஈஸியா இருந்துச்சா? This is one of the easiest thing, and 50% chance that questions will come from this only. Okay, 50% probability, and the EBIT, EPS, MPS analysis every 2-3 exam one time they are asking. Okay, so you may be the lucky one to get this into the next attempt. Clear? Okay, no questions, right? I know you will not be having any questions. Either everything is very clear, or maybe you have to go out. Enna reason? Both. Okay. So see you. Okay, see you in the next class. Thank you very much.